Welcome back to another video here on P2P Empire. Today we'll be introducing you to a 5-step process, or better a framework that will lead you from a complete beginner to an informed P2P investor. My name is Jakub, and if your goal is to become a more educated P2P investor, consider subscribing and hit the like button if you want to see more videos like this in the future. So if you have been following this channel for a while, you know that we talk about different aspects of P2P lending, we review P2P lending platforms and talk to the people from the industry. If you're a beginner and you are just doing your research about P2P lending, it can be quite a challenge to find out where to start. There is not really any process on the internet that describes how to invest in loans and make money. This means that you might skip important steps and invest blindly. The result of this strategy will increase your risks towards P2P investments. So in this video, we will lay out the exact process of how to start with P2P lending. It's also packed with valuable information in my personal experience from P2P lending over the past 4 years. You should note that this framework can be applied for any P2P lending investment product. However, you will get the most value of it if you are based in Europe or if you have a European bank account. The thing is that mostly we review European P2P lending sites, and if you want to invest on those platforms, you need to follow certain regulations, and one of the rules is to have a European bank account. Now, let's start from the beginning. So you have got an idea to lend money for profit. Banks and lending companies are making millions from lending businesses, so how can you do the same, right? The answer to your question is P2P lending. So how does it work? You as an investor will invest in loans from other people through a P2P lending platform, and in exchange you will receive interest. That's at least the basic definition of P2P lending, and if you want to learn more about it, I suggest watching this video where we explain the different business models. Okay, so now you might have a ton of questions about how to practically do it and what you need to do. Let's try to address them in the following 5-step process, or let's say a framework that will make you a well-informed investor. As with any investment, you have to first define your strategy and ask yourself, why do you want to invest money in the first place? Believe it or not, having a strategy in place will have a huge impact on the yield from P2P investing. Do you want to get extra income? Do you want to use P2P lending as a way to diversify your portfolio, or are you saving up for a bigger expense in the future? The thing is that you don't want to invest without a reason. Within this stage, you have to evaluate your financial situation. Some factors could be, for instance, your income, how big are your monthly expenses, do you have an emergency fund, what's your age, do you have family or kids? This all influences your investments, and you don't want to put your lifestyle at risk. You should never invest money that you might need for something else. Next, you should define your expectations. How much do you want to earn from P2P lending? A realistic yield is between 7 and 11% after taxes. Expecting to make 20% interest per year on a long-term, consistent basis is just not realistic. If you imagine making this much interest, you will likely take bigger risks, which may not pay off and you might lose your capital. You should also think about the investment period. Do you want to invest for just 12 months, or do you plan to grow your portfolio for several years? This influences the investment products you choose, both in terms of liquidity as well as the amortization type. To put it simply, if you want to invest short term, you should choose investments where you can get quick access to your capital and where the interest is being repaid on a monthly basis. Your expected yield will also influence the securities of the investments that you are making. A loan secured by a mortgage will yield typically between 7 and 10% interest, whereas unsecured consumer loans earn from 10 to 16% interest per year. Now that you have defined your strategy as well as certain investment criteria, you will have a much better idea in what type of loans you want to be investing in. But before you start investing, you should first understand the concept of P2P lending. This is certainly not the most exciting part, but it's crucial for you to understand how the different business model works. So here are the basics that you should be aware of. Most of the loans that you are investing in fall into two categories. You invest either in consumer loans or business loans. Now, unsecured personal loans could be short-term payday loans or long-term consumer loans. The difference between those two types is that short-term loans are given out to borrowers who are looking to borrow money for a shorter period. It's also no secret that many of those loans are given out in countries where there is no regulation. This means that lending companies can charge extraordinarily high interest rates as you would not expect in your own country. Depending on the country and the lending company, the borrower can pay between 40 and 400% interest per year, in some cases even more. It's kind of hard to generalize here too much, as every company follows different lending practices, and it's also no secret that the payday loan industry is quite profitable, but it can also be quite risky. The benefits of short-term loans is that the lending company can collect the payments within a short period, which allows the company to be more flexible during changes in the market. On the other side of the pond, you have the business loans, which are either secured by a mortgage or by some personal guarantees. When investing in business loans, you should always inspect the securities, as they can vary quite a bit. If the loan is secured by a mortgage, try to look up the company who has done the valuation and see whether they have a solid track record in the market. Business loans are generally quite risky, as many platforms within this niche have offered extraordinarily high interest rates just to lure in investors into their Ponzi schemes. Investing in business loans on unregulated platforms without much track record is therefore a very risky investment, and we suggest to stay away from it. What you should also be aware of is that many business loans are being repaid at the end of the loan term. This means that you won't receive any principal repayment or for several months, and in many cases the same is valid for the interest payments. With consumer loans, you are being repaid interest and loan principal often on a monthly basis, which continuously decreases the default risks. That's not the case with business loans. To better understand the concept of P2P lending, you should be also aware of the two P2P lending platform models: marketplaces versus P2P lending platforms. A marketplace is a platform that does not lend money to the borrowers directly, but to various lending companies so they can fund their loans. This means that a marketplace is just a middleman between the investor and the actual lending company. The benefit of this model is that a marketplace can list much larger amount of loans, since it lists loans from several lending companies, and this can help with your diversification of your portfolio. On the flip side, a marketplace does often not have direct access to the borrowers, so it only relies on the information that the lending company is providing. The marketplace is mainly financed through the commission from the lending company, so it's in their best interest to fund as many loans as possible. The disadvantage of this setup is that you as an investor bear the default risk and that the marketplace does not have any of their own money at stake. This means that the marketplace is not as interested in monitoring the performance of the lending companies, and if the lending company decides not to pay back the money to investors, the marketplace often struggles to recover the debt. In this scenario, it's likely that you may lose some money. The second model is the P2P lending platform. In this scenario, you sign up on a platform that is the lending company and lends the money directly to the borrowers. The benefit of investing on P2P lending platforms instead of marketplaces is that the platform is much closer to the borrower. This means that they are also in charge of the debt collection. You can also eliminate the middleman, which further decreases the risk. A disadvantage could be the lower number of loans which you can invest into. You are basically investing in loans from one lending company, whereas on marketplaces you often have the chance to invest in thousands of loans from dozens of lending companies. When it comes to P2P lending, however, you should always prioritize the quality over quantity. So by now you have defined your investment goals, and you are also aware of the differences between consumer and business loans, as well as marketplaces versus P2P platforms. Now it's time to finally find the right platform for you. Finding the right platform is likely the most time-consuming task. You will need to do a lot of research to find the best fit for you. Within this stage, you can always use P2P Empire to get a brief overview of the currently available platforms and see whether your research matches our findings. You should not skip any steps here, as this will have an impact on your long-term experience with P2P lending. You don't want to be moving funds every month from one platform to another, but rather build up a portfolio on a platform that supports your investments in the long run. So here are all the points that you should be looking at. First, check the loan availability of the platform. In most cases, the platform shows you all the available loans at the moment without the need of creating an account. If the platform or marketplace is listing consumer loans, there should be at least a couple of hundred or even thousands of available loans. If the platform offers business loans, there should be at least a handful of available loans. When starting out with P2P lending, you want to first test the waters and invest the minimum investment amount into one loan. As for consumer loans, it can be as low as €1, and for business loan, it's typically at least €50. Apart from the loan availability, you can also inform yourself about the average interest rate offered on the platform. Note that every platform uses a different calculation for this metric, and some of the platforms don't update this on a daily basis. The average interest rate will give you a rough idea about the currently available interest rates. Note, however, that this rate typically does not account for defaults or loans in recovery. The actual yield depends on the loans that you have invested into and their performance. Depending on the platform, the actual return can be very different from the promoted yield. Especially when it comes to business loans, the realistic return can be much lower. Another increasingly important factor is the regulation. Most of the P2P lending platforms are not regulated. This is mainly due to the slow implementation from the regulators. As there is currently still no official regulation by the European Union, some platforms got licensed by local regulators. In Lithuania, many platforms are regulated by the Bank of Lithuania. In Latvia, some marketplaces applied for the investment brokerage firm license, and in Estonia, platforms remain self-regulated, which is not typically something you should primarily rely on. Regulated platforms need to fulfill certain requirements, and the goal of the regulation is mainly to protect investors from scams. You should certainly check whether a platform is regulated and by who. You can find this information either on P2P Empire or directly on the P2P lending platform. When in doubt, you can always reach out to the support team of the platform to get this information. When conducting research about your platform, you should definitely check out the track record of the company. Many platforms provide a statistics page where you can get a brief overview of the most important metrics. Look out for information about defaulted loans, total loan volumes, investors' earnings, and the number of investors. This will give you a good idea about the popularity and the size of the company. You should also have a look at the company's blog. A great example here is the blog on Estate Guru, where the company shares monthly portfolio updates and presents many case studies from projects they have funded. A very poor example can be seen here on this website, where you won't find any value whatsoever in any of the blog posts. What you want to be looking for are specific information relevant to the platform and its partners, and not general advice which isn't even relevant to you. In order to find the right platform, you should do your own due diligence. In short, you should verify as many claims as possible. Many platforms like to use marketing language to make them seem better as they actually are. You should certainly look up the LinkedIn profile of the CEO and owners of the platform. Try to evaluate whether a conflict of interest has a positive or negative impact on your investments. In certain scenarios, the owners of the marketplace can own several problematic lending companies which list loans on the platform. In those cases, you want to gather as much information as possible about the performance of those lending companies before you start investing in them. You should also make sure that the CEO or owners of the platforms are not connected to frauds or money laundering. Before you sign up to any P2P platform, I highly recommend you to reading the terms and conditions to fully understand your rights and the risks that you are taking. Certain terms and conditions also refer to a list of fees which you should be aware of. You might get charged for investing on the primary market or trading on the secondary market, and certain platforms charge you for an additional protection fund or even for withdrawals. You should also have a look at the financial reports. Almost every legitimate P2P marketplace or P2P lending platform has their financial reports audited and publicly available on their website. In those reports, you should have a look at the profitability of the platform and also whether the expenses of the company can be justified. Another important step that you should not skip is to educate yourself about the lending practices of individual lending companies in which you are investing. This is a more complex and abstract task, but it will help you to evaluate the risk of investing in particular lenders. So for instance, investing in a lending company that funds more than 90% of their loan book via P2P investors is not the best strategy for you. If you wonder why, it's actually quite simple. Those lending companies are over-leveraged and highly dependent on P2P investors. This is not a very sustainable way in the long run, and if the market conditions change, the lending company will have a hard time to adapt, as it does not have enough cash to sustain the business on its own. Ideally, you are looking for companies that use leverage from P2P investors but are not over-leveraged. A good sign is to also inform yourself about the default rates of the lending company, as well as about the ratio of repeating customers. To wrap up your due diligence process, I highly recommend watching our P2P talks with several CEOs or experts from the industry. Those interviews will give you a good impression about the people in charge, and there are always some good takeaways which will help you to be more informed. Unlike some of the other interviews on YouTube, Our talks are not sponsored. This means that we can have an open discussion about basically whatever we want. The topic that we are covering always consists of questions from our community. That way we keep it relevant to you. So far, we have also never been in a position where we have been asked to censor parts of the video, which certainly increases our impression of the transparency on certain platforms. On the flip side, we also had platforms that refuse talking to us. If that's the case, we will highlight it in our P2P lending reviews. If you want to contribute with your questions to some of our upcoming interviews, you can join our newsletter and we will inform you about any upcoming P2P talks. So all of those tips will help you to find the right platform for you, and in the next stage you will sign up and finally deposit money. Now you should have all the information that you need to get finally started. To sign up to a platform, you have to be over 18 years old and you have to have a European bank account. You will need to verify your identity and pass the Know Your Client form in order to create an account and be able to deposit funds and start investing. After you have done that, it's time to get familiar with the platform. First, you should have a look at how the AutoInvest works. AutoInvest is basically a tool that you can use to define your investment criteria and automate your investments. Every AutoInvest looks a little bit different, so it's recommended to get familiar with all the filter options and define the criteria which fits your investment strategy, which you have already defined in the first step. It's also recommended to have a look at the secondary market and see what kind of options the platform offers and how you can sell your investments in case you need to. You should also read the terms and conditions for the AutoInvest as well as inform yourself about the price for the secondary market trades. As soon as you get familiar with the platform, it's time to start executing your investment strategy. When starting out, you should start with smaller amounts. This will help you to get familiar with investing. The thing is that many investors are obsessed over their investments as they are emotionally connected to the money, which is now no longer in their bank account. You have to let those emotions go and detach yourself from your money. That's the only way to go about it. Being informed about the risks of P2P lending and confident in the choice you are making will help you to overcome this phase. You should always be committed to your investment goal, and as you gain more experience, you can also increase your investment amount. And that's basically how you get started. Now let's talk about the last stage, the monitoring of your portfolio. What many investors do is to set up the AutoInvest once and never touch it again. In a couple of months, they remember that they had some investments on a platform, and they log in and just to find out that 30% or more of their investments are in recovery or defaulted. Don't make the same mistake and keep an eye on your portfolio. You should log in at least once a month to check whether your funds are fully invested and evaluate the performance of your investments. Look at how much of your loans are delayed and whether you are receiving interest for them. Also have a look if you have some defaulted loans. If yes, reach out to the platform or head to their blog to educate yourself about the status of the defaulted loan. On certain platforms, you can also sell the defaulted loan on the secondary market. What you should also be doing is to sign up to the newsletter on your platform. You want to be informed about changes of their products, terms and conditions, and changes of the management. Reading all of the platform's blog posts is also a good practice just to keep in the loop in case you have missed an email. All of this has an impact on your investments. You can also subscribe to our monthly newsletter to get a broad overview of the recent news from the industry. What you can also do is to join dedicated Facebook groups or Telegram chats. There's currently a group for almost every platform where investors exchange their opinions. From time to time, there are some good insights that you can use to improve your performance of your portfolio. So that's basically how you keep in the loop of the news that are relevant to your investments. Some investors tend to go full on passive mode and don't monitor their P2P investments. At the end of the day, it comes down to you and how you approach your portfolio. Monitoring is certainly more time consuming, however, it can give you a lot of valuable insights that you might not have learned otherwise. So, if you have made it this far, congratulations, you are now ready to lend money for profit and start investing in P2P loans. By now, you should have a good overview of how to do it. If you want to learn more about certain specifics, browse through this channel. There is plenty of videos where we share some of our mistakes and losses. Use that information to avoid the same mistakes. It's going to save you a lot of time and money. You should know that P2P lending is not a get-rich-quick scheme. It takes quite a bit of time to get familiar with the asset class, and you should certainly put some learning money aside. if you are thinking investing a couple €1,000, you should first consume all of the content that's available, and if you still have questions, reach out to the platforms by yourself. If you have any other tips that you would like to share with new investors, write them in the comments below this video. That's it from me today. Thanks for watching. I will catch you in the next one.